everyone, and welcome to a session here with Dave Herbst, who is a good friend of mine, VP of the AIO All-in-One Home Loan Program here at CMG Financial. I'm in Irvine, California, and do loans across the country in many different states, but primarily here in California. And I've gotten to know Dave over the last 3 years that I've been here, 3+ years that I've been here at CMG. And Dave, you've been here much longer than that, but I'll let you digress into those conversations. But what I wanted to do is introduce you and to talk about this product that's been setting my business on fire, and the business of my real estate partners and my customers who have just come to find this thing just amazing. And we're talking about the All-in-One Home Loan Program. So welcome, Dave.
Yeah, thank you so much, Brad. It's always a pleasure to join you in meetings and presentations, whether that's out there physically in the market or virtually like this. But I think people are sort of starved for some new information about alternatives and the innovation that we've certainly set forth in unfolding and developing out. And so, I love opportunities like this, especially to do it with you.
Thank you so much. So I wanted to start the question off, and this is a very generic, high level question. What is the all-in-one loan? What makes this loan what it is? Why is it different?
Yeah, I mean, as the brand name sort of implies, it is a combination of two everyday, financial instruments bundled together, merged together. And, of course, we're very used to having products and services bundled together these days, right? From auto insurance and home insurance to, telecommunications along with cable and other things. When you really kind of sit back for a moment and think about what could be bundled together with a mortgage, it begins to make a lot of sense to really take a deep dive into how we manage our debts and our finances. Most of the money we utilize to manage, mortgage payments on automobiles, grocery shopping, just our income management. That's all really performed out of an everyday checking account, traditional checking account. And most Americans don't realize it, but they will tend to flow or manage more money through a checking account in just 5 years than the total amount owed on a mortgage. And that's really where the concept begins. Like, why are we keeping our cash, our valuable resources separate from what is likely life's biggest expense, which is our mortgage? So the all-in-one loan really is built on the concept of merging the two together, merging personal banking with home financing, a mortgage and a checking account bundled together. And the purpose of the product is to help people have an easier, a safer way to reduce the size and the cost of their mortgage by utilizing money they already have in their possession through an instrument, quite frankly, that they're already proficient at using, just a regular checking account. So this is a loan product that finances real estate. It comes with a linked checking account that's uniquely engineered to help shrink the mortgage balance faster, and in doing so help save enormous amounts, tens of thousands of dollars in monthly and annual interest payments, while keeping that customer liquid with their money and their home equity money. So it's a very liquid and powerful financial tool that can help people in a variety of different ways.
So this is a product that combines a checking account with your mortgage, is what it is.
Yeah.
And when I've talked to my customers, I do tell them that it's about changing their checking account more so than changing their mortgage company, because it starts with a mortgage. We have to set that up, and then we set up the checking account, which is tied to the mortgage. Mm-hmm. And so tell us how this works. So you have this checking account that's tied to a mortgage. Why would somebody do something like that as opposed to a traditional mortgage program with a checking account separate?
Well, let's start with the mortgage side of things. The reality is that mortgage is the traditional financing that we've utilized, in this country for a very long time, has really lacked innovation. There's not been a whole lot of thought or effort put behind changing the way money is actually applied to the debt itself. Traditional loans are amortized, closed-ended financial instruments, meaning that money only flows in one way. You can't take money out, right, unless you refinance, get a different one, or even a second lien on the home. So the other thing is that because of the way that money is applied to the principal balance, and also how interest is built into that payment process over time, the reality is that low interest rate mortgages, even a fixed rate loan with a low rate level, still has a high cost associated with it. I'll give you a quick example. 3% mortgage borrowed over 30 years will cost the customer about $52,000 in interest for every $100,000 that is borrowed. At today's interest rates, 5-6%, that's closer to 100%. So in other words, for about every $100,000 being borrowed, it's about $90,000 or $100,000 in interest cost. So, mortgage financing is not cheap. It's not inexpensive. It's very expensive. The average American will spend most of their adult life in mortgage debt, right? And spend most of that paying for their home. So when you to answer that question, I think you really have to start at really this necessary evil, which we know as the mortgage. Most Americans have to borrow money and utilize a mortgage in order to buy and possess real estate, without question. It's an expensive endeavor. It's very, it's very appealing. It helps us grow, wealth over a period of time, and hopefully generationally pass that on, help stabilize markets and the economy and commerce and all these things. But it adds an expense to a customer's life that is just enormous. That expense also impedes progress with other things, by the way, financial security for retirement needs and other areas. So, minimizing the cost of interest is really the focus. How do we do that without forcing a change in budget? How do we do that without disrupting, lifestyles? How do we do that without chasing interest rates around or relying on, interest rates moving favorably lower? Can we achieve savings by not having to depend so much on interest rates or economic cycles? The answer is yes, because most Americans who can afford homeownership possess the resources necessary to get rid of debt faster. And that money tends to flow through a primary checking account, right? And is managed from there. So ultimately, for those people that are interested in, shedding cost in their life, not necessarily paying off their home, I think that's less tangible. I don't think that many people, honestly, Brett, as well as I do, I don't think that people wake up going, gosh, if I could just pay off my mortgage, that'd be great. It sort of seems, it's an intangible. It's something that really seems that it's lofty. It'd be nice, but it's maybe not attainable. So I don't think that innately people feel that they're capable of doing that, just in general. But what people can relate to is, having more money on hand. If they just simply were able to avoid costs associated with borrowed money, then that would leave them with more of their own hard-earned dollars left over for bigger and better things, to include mortgage payoff or maybe funding a child's education without having to go get another loan. So, the idea behind the loan is to combine the management of their income with and directly into the mortgage, so that they make faster progress towards pay down and interest savings and live a lot more securely.
So what I've observed from the product, and what I found very impactful for my customers, and what they've found impactful, is that the money flows both ways, which is unique to the type of product it is, as opposed to your standard amortized or interest-only type of product that's out there. 95% of the American culture is based upon the standard amortized product. Mm-hmm. And what you said is exactly right. They're trying to find a way to manage, not necessarily figure out a way to pay off things. Yeah, they have a dream of paying off, but then what? Right? They have a $500,000 house that's paid off. They have a $500,000 paperweight that's sitting on their desk that's doing nothing for them. Right? So they have this equity that's tied up. Great, they don't have any expense with it, But then invariably they always get a bee in the bonnet, so to speak, where they decide,
Right.
okay, well, now that I've done this, I've achieved this. Now I want to go create this investment and start making this equity work for me. So then, as you and I both know, what's made the banking world very wealthy is the repeat customer that comes back year after year after year to chase rate, to chase cash out, to chase whatever, because that's the only way they can access their equity. And in this product, because the money goes both ways, you really never need to change out of the product. And so it's almost a one and done type of concept, where if your goal is to pay off, then that is there for you, and you aggressively pay it down with your regular earnings without doing anything different, just your regular home earnings. And if you want to pull the money back out for college, for a vacation, for purchasing an investment property, or purchasing some other type of investment vehicle, it's all there, set up, ready to go.
I think that's a key factor here, is the liquidity aspect of it, right? We all know that paying extra towards, a debt will help save time and money. Very few people actually put anything extra, right? There's almost a disadvantage or disincentive by doing so, because your money's locked up, as you stated here, in the debt instrument, in the mortgage or any other loan. Your money's locked up in it. It's not liquid, and you may need that for something right around the corner, whether it's planned or unplanned. The benefit of the all-in-one loan is that the mortgage, the financing, is actually powered by a 30-year draw, first lien position, home equity line of credit. The only one that I'm still familiar with in America. So again, let me repeat that. A first lien position, 30-year draw, home equity line of credit is what finances the real estate. But it comes with an embedded or linked zero balance sweep checking account. And I know that's a technical term, but it's a good descriptor to remember. It's a checking account that's engineered not to keep a balance in it past midnight on any given day. Where does the money go? Well, it's swept to the mortgage, the line of credit. So what I just described, Brett, is a product that not only keeps your money accessible and liquid, which is the real key factor here, that makes it safe, right? But it's also engineered to use money that would otherwise reside in a traditional checking account or savings account, yielding very little in return, 0% or close to, while the mortgage, regardless of the interest rate, is still costing customers higher amounts, higher interest rate levels, and higher amounts of interest over time. So this creates a higher efficiency, a higher use of that idle money, if even for a day, because money floats, right? And there's value in that. There's time value in money as it resides. And as you eloquently put, that's why banks are banks. And I'm not demonizing the system. We've depended on it and still do. This just creates an alternative, a better choice to utilize idle money, if even temporarily for a day or 2 days. But the reality is money kind of floats for days and weeks on end. So this allows customers to essentially save or avoid mortgage interest expense at the rate of the loan versus earning 0 or close to 0% on that money in a traditional bank account. The net result of that is that, interest avoided means that our customers are left with more of their own money to do bigger and better things with. And we feel that's important for people today.
That is a very important thing. And I've been finding that very important with my customers, my realtors, and even financial advisors who I've been talking to about the product. They've been finding some enormous value in just how it's structured as opposed to the traditional products that are out there. So with this type of a program, it's interesting that as I started learning more about it, it seemed to me like with the way that's set up with the offset checking account that's set up with the mortgage, you can go back through, for example, your own checking account with brand X, whatever that might be, and you could add up all the deposits you've had over 12 months. And if you were to be pointing those deposits toward the all-in-one mortgage, you could potentially have your house paid off in 3, 4, 5 years. How many of us earn, in excess of a certain amount of dollars. And when we look at our mortgage, we say, well, if I didn't have any other expenses at all, and the mortgage was my only expense, I'd have it paid off in 3 or 4 or 5 years. So this program actually does that for you without you changing your spending habits or lifestyle.
That's right. And one of the mathematical factors at play here that makes that possible is not just that every deposit is automatically applied to loan principal first and only. So let me repeat that part of it. Every deposit is automatically applied to loan principal. There's never a time where a deposit made into the all-in-one loan checking account goes towards paying interest on the loan. It always is applied to loan principal, reducing the balance in which interest is computed on. So here's another key factor is how interest is computed. Instead of like with a traditional loan where it's amortized and predetermined upfront, this loan has no predetermined interest. It actually will recompute nightly at midnight automatically. So it's the only mortgage in America that also recomputes interest every 24 hours on whatever the unpaid principal balance level is at midnight every single day. And once the monthly cycle ends, each day's interest is just totaled. That's the interest payment. And even then, Brett, the interest payment isn't due until 21 days later on the 21st of each new month. So what I just described is exactly the opposite of, traditional financing here in the United States, where you set in motion kind of this, financial product that already sort of impedes your progress. There's interest loaded up front, right? Right out of the gates, you're paying more in interest costs than you have the ability to pay down in principal. The exact opposite is true with this loan. It's principal paid first, interest is paid for in arrears, but not just in arrears, 21 days in arrears of every month that just ended. We essentially are separating the P principal from the interest. Those are paid for in two separate events. Anytime you make a deposit, principal balance reduces that day, offsets the amount of interest that you're going to be charged by the end of that monthly cycle. And interest isn't due until 21 days later. So it really creates this gratifying kind of visibility and control factor, I think, given the way that interest is computed, to help customers achieve their goals. Again, whether home payoff is something they want to achieve, I think that it's about empowering customers to make better choices, right? Because that better choice may be something other than mortgage payoff. It may be investing again sooner in real estate. It may be supplementing, college education for children. It may be getting more aggressive with your retirement security needs, long-term savings needs. It may be funding an unplanned emergency that is unforeseen today, but may arise tomorrow. These are things that I think people want more money on hand for. One of the ways you can do that is by avoiding mortgage interest expense.
I think you hit on a key here, and you mentioned the concept of better choices. So I think that really what the all-in-one does is it provides more choices. It's really up to the consumer themselves to decide if it's a better choice or not. In my experience of delivering this product, some customers are better off with the traditional 30-year fixed. Granted, this is a better product for them, and so we're putting them into that product as opposed to the all-in-one. And then there are some that just the all-in-one is just an amazing fit for what they are doing in their life, how they earn their income, and how they're controlling their finances. Mm-hmm. So I think that that was a key concept that you delivered. Thanks very much for that. And then the other one was, how the payments are different, right? So your 30-year fixed rate payment, right? Your payment is due on the first of the following month, every month like clockwork. And the money only flows one way, right? You're paying principal and interest. So you're already paying a piece of principal, already paying interest, and the money only goes one way. Whereas the all-in-one, it's very fluid. As you're making deposits into your account, it's going towards principal first. And then at the end of the month, the interest is calculated, and then the interest charged on the 21st of the following month. But what I found very unique about the program is there's no monthly mortgage coupon payment book that goes out to your customer. What it is it's a checking account statement with the mortgage attached to it. And what it looks like when you get your monthly statement, it looks like a service charge that's coming out on the 21st of each and every month is just getting interest assessed to the account. So you don't have a payment structure like you do on a traditional mortgage. Yeah, that doesn't mean that you don't have interest that you owe. Yes, you do have interest that you owe each and every month, but that's based upon the daily rate, as you alluded to, and it's calculated on the 21st. But you don't have a payment book. It just comes out of the equity of the account itself.
That's right. That's right. You're building equity in your home, which is kept liquid and secured by the mortgage itself, right? It's a security instrument. It's a home equity line of credit collateralized by the property. And as you deposit money and you build equity in the home, and that equity money is available for use 24/7. So whether you need to go grocery shopping, tomorrow, or make a cell phone bill payment, you can do that. The idea behind the loan is that the customer benefits from their cash more so than any bank would. And the longer you keep money in the mortgage, the longer your balance will remain lower, in which interest is being computed on nightly. That minimizes the amount of interest that they'll have to pay once the month is over. That's not due until the 21st of that following month. And so, another way to think about it is, instead of sort of a payment plan, the all-in-one loan provides guardrails, right? It's a credit line with a limit, a borrowing maximum that customers apply for and qualify for, and we close it at. And that credit limit remains available to them over the 30-year term. And it's also structured very differently than a traditional HELOC, keeps them liquid for that 30-year period of time. So a lot of maneuverability. I think that optionality is very valuable. But in the meantime, what we're allowing somebody to do is control their principal balance and have much greater influence over their interest cost. The guardrails of really interacting or engaging the debt instrument allows people to really, yield a result relative to what they want. And I've always found it fascinating, Brett. You've probably heard me repeat this in the past, that, I find it kind of fascinating. We in the industry are pretty used to delivering, really the same products, one or two different types of products, really, to most of the market. Statistically, about 9 out of 10 Americans with a mortgage have a 30-year loan on their home. And I've always been fascinated by that, knowing that our customers are different. Every single person is different. A lot of similarities, of course, but most of us are very different from each other, have different goals, levels of income, financial obligations. But yet we tend to deliver 9 out of 10 times, roughly, the exact same mortgage product for our customers. The all-in-one loan is different because you get to tailor the results, right? You really get to take greater control and customize the results of the mortgage and your housing needs relative to your life, instead of just being, kept in a payment plan that you can't navigate away from or change very easily. So yeah, it's much more of a financial product or tool than it is just a mortgage.
How would you, I'm going to shift gears just with one more question. Maybe we can talk about this topic. I do a lot of business with some financial planners, and once they've had a look at the product, they find some value in it with respect to recommending it to their clients and customers. I know that you've had extensive discussions with financial planners as well. How, in your words, do they find the product as an advantage tool in helping them help their clients manage their finances?
Yeah, well, I by all accounts, most Americans, especially pre-retirement households, are lacking in their long-term savings needs, specifically retirement security or savings towards retirement security. There's studies that are done and performed and published pretty routinely by a series of government think tanks that study the deficit that is growing here in the United States amongst pre-retirement households, Gen Xers, baby boomer generations that are otherwise doing everything right, traditionally correct, but still in deficit of having enough money saved, put away for their retirement needs once they're out of the labor force. And that's a scary thing. Most Americans don't realize it, but as the cost of living goes up, so does their need, right, for tucking away more money for those longer term needs. And I think a fiduciary, a holistic planner, is tasked with continuing to not just manage their assets, but also take a look at the liability side of the balance sheet. if you will, right? If you can cut cost and try to reduce expense or exposure to expense, therefore allowing a customer to have more of their own earnings on hand for bigger and better things like building retirement security, then it just benefits their cause. It just absolutely speaks to what they're employed to do, which is to help secure somebody's financial independence, given what they have to or challenged by over that journey. So for financial advisors specifically, holistic planners that look at both sides of the balance sheet, I think this loan, I know it does, it speaks volumes to exactly what they're trying to achieve: financial independence and security for their customers. One way to do that is to minimize the expense of a mortgage quickly. 0% is the goal, right? Nobody wants to pay 3% for the rest of their life. Nobody wants to pay 5% for the rest of their life. I think we all want to get to a place where we're paying 0% on our debts. Doing things the traditional manner really impedes that process. While as you stated a minute ago, conventional mortgages, as we know them, have their place, right? For the right people during the right stages of their life, they're very beneficial. But for others who are a bit more financially disciplined and established, and probably need some help, sort of a cut in line financially to get further along sooner. We find that conventional mortgages are slow, they're rigid, they're inefficient, and they add expense to unnecessary cost to those people's lives. So this just speeds up the process, shrinks the size and the cost of the mortgage sooner, does it safely because it keeps money liquid. That's a key factor. That's a key benefit. And that allows a financial advisor to help plan with their customer, with their client, right? Maybe 8-year payoff isn't necessary today. Maybe a 10 or 12 or 15-year payoff will help them meet their goals. So if you had that choice to maybe even slow down the payoff of a mortgage and begin to farm savings out of the mortgage instrument and utilize those dollars for maybe investing and it's just cash earnings to invest or to tuck away for other things. You have that optionality with the product.
And I think the key is that, as we talked about earlier, that the money goes both ways, right? So do you have a $500,000 paperweight sitting on your desk? Or do you have a financial instrument that allow you to be flexible and to move money both ways? And so what I have found in my discussions with financial planners is that the traditional products, the 30-year fixed traditional products, although that's a great way to go, it ends up being just a paperweight for the financial planner. So you get, say, your 30-year fix, you put it in place. Maybe the financial planner helps you organize that and put that instrument in place for your finances. Well, in essence, once that's done and that's set up, the financial planner knows it's there, they manage it, but it's just set aside. It's just dead weight. It's sitting there. Mm-hmm. Where, right, as opposed to this vehicle, you can go back and forth. So if, for example, let me just put it this way. Let's say you have a financial instrument that costs you 5%, okay, but you have an investment opportunity that earns you 10%. If you've got a fixed instrument where the money's fixed in there, you can't pull it back out, where you're just stuck with your existing assets to move into that 10% investment. But if you've got that fluidity to be able to go back and forth, the question comes, if you had the chance to pay 5% but earn 10%, how much would you borrow?
Right. That the leveraging, the option to deleverage and leverage, timely, is so valuable. That's it exactly. It's not one way. It's not one thought process. It's not one methodology or strategy. It's the ability to maneuver and decide based on your needs, based on the period of your life that you're living in, and all the things you're challenged with. That's, I think, is invaluable. We just don't tend to manage our debts. Debt instruments aren't designed to create that kind of value or flexibility. And it's, truly, I can't think of a better way to manage not just real estate, but, a variety of different financial needs than having a flexible credit facility that is there for you, like the all-in-one.
Exactly. Well, Dave, I really appreciate your time today. It's been invaluable to have a conversation with you, and I respect your time. We can go on, you and I can go on hours and hours in this, but I also respect the viewers' time. Keep this to maybe 30 minutes tops as a discussion. Listen, if you are interested in the all-in-one home loan program, you can reach out to me. I'm Brett Smith, CMG Financial. I'm here in Irvine, California. I've been doing these all-in-one loans for a number of years now, and I love the product, and I think that it can definitely benefit a great segment of our population. And so, Dave, from me to you, thank you very much again for joining today. And any parting words?
You're a true professional. It's always, you're just a class act, Brett. I can't think of anybody better to partner with. And I'm glad I'm your associate, and just let me know what I can continue to do to support your growth and exposing your ability to do this loan. It's a loan product that one of the things I do love about it is that it really helps the average person. It just does. You don't have to be savvy or super affluent to benefit from it. This is designed for the average American. But what I also love about it is it does require true professionals in the industry that have committed time in themselves and time to educate others in order to be successful. And that's exactly who you are and what you do. So it's a pleasure to be here with you, and I look forward to future involvement with you.
Thank you so much, Dave. Everybody, thank you for joining, and have a great day.